This is Derek as well, Chief Investment Officer for Shelton Capital Management with a Shelton CIO Minute. About 2 months ago, we noted that the spread, the difference between 3-month T-bills and the 2-year Treasury was over 1%. And this indicated that expectations in the market were for a very rapid drop in the federal funds rate. Well, 2 Fed meetings later and another 25 basis point hike, expectations have changed quite a bit. While T-bills still return about 5.25% or more, the 2-year has caught up and is up 1% and even touched 5% at one point last week. Going along for the ride, the 10-year bond is also hovering right around 4%, which is near its highest levels for the year. Now, long-term bonds generally driven by the state of the economy, while the 2-year bond is some kind of a mix of growth and inflation expectations. But the bonds rise are showing that this resilient job market that we've experienced could prop inflation levels up for a while longer. As far as economic growth goes, the yield curve is still inverted and has been since November. And on top of that, leading indicators are still weak. It can't take some time since these signals after these signals turn negative for economic growth to actually slow. Sometimes anywhere from in the past 6 months to even a year and a half after a yield curve is inverted do recessions actually strike. And it is easy to see how the activity from the pandemic stimulus might stretch that time out even further. So the key here, be patient. We're not out of the woods yet. For further information about Shelton Capital, please contact your local Shelton Capital representative. This has been a Shelton Capital CIO Minute.